Good morning, everyone. Welcome to this update for the new year for January 2018. Apologies, this is a day late, but we're having a long weekend for our wedding anniversary. 2017 was a really good year. There was good, steady progressions in markets, and if you had your game plan sorted out, then you should have done pretty well. But what an extraordinary start to 2018 that we've had in just 4 trading days. The American market, in fact, a lot of global markets went up very, very substantially. The Australian market, not as much, but still had a pretty positive start. So, of course, the real question now is what's in store for us in 2018, and so I want to shed a little bit of insight into that this morning. So, looking at what this first absolutely stunning week has shown us, my view is that this is really time to take advantage. We've been in a bull market now for about 9 years, and it has been pretty much a hated bull market, and we're only just sort of reaching the acceptance stage now where people are starting to get a little bit excited about the market. We've still got a long way to go, but I expect to see an acceleration in trends this year. What that will mean, of course, is we will see the indices perhaps move further away from their trend lines than we've seen in the last couple of years, and that may mean that we're going to get some sharper pullbacks because they've been almost absent for the last 2 years. So I think that's what the market is telling us. But let's take a look at the charts in a minute. And of course, there'll be the general updates on stocks and commodities. Portfolio analyst recommenced last week after a 1 week break, and I provided a perspective on China, which is really the US listed China stocks have really started to motor again. I had a look at a review of the US themes for 2018 and identified what are the sectors and industry groups that are set to do best in 2018. There was a speculative local recommendation that burst out of the blocks basically the day after I made the recommendation, so that's looking quite good. And there was also a strong local healthcare buy as well, so that was portfolio analyst last week. The backdrop, just in general terms to the markets for 2018, there is no recession in sight, so you can forget that one. And backing that up, these are some of the fundamentals that really support that fact. We've just had a new all-time high in US retail sales. We've had a 10-year high in home sales, a 3-year high in manufacturing growth, and a 40-year low in unemployment claims. There is no question about how well the US economy is going, and with the tax reform now done and dusted, things can only get better for the US economy. There is quite a bit of debate about what degree of positive impact that will have, but I think it's safe to say that it's going to be positive, and we haven't seen the best of it yet. Now, the US corporate tax rate has just gone from being one of the highest amongst the G7 countries to the lowest. So this is an absolute game changer for the US and has all sorts of ramifications that are going to take several years to play out. And I think they're all going to be certainly positive for the stock market. We can debate the degree of positivity, but I don't think there's anything negative in there at all. In terms of finding opportunities, and I cover this quite regularly because it's part of your overall strategic approach to the market. I think there's 2 ways to find opportunities in 2018. One is to either buy existing strength, so buy stocks that are in existing uptrends and buy a pullback in that uptrend, and basically follow in the footsteps of the institutions because they're the ones that are moving the market. The other way to find opportunities is to monitor the underperforming sectors and look for signs of renewed life. And I'd been doing that with energy in particular. And if you think back to 2017, I identified energy around about the middle of last year as starting to build up some momentum, but I was a little cautious and was looking for confirmation. So around about August, September last year, I recommended starting to initiate a few tentative positions just to get your foot in the door. But energy now has certainly confirmed that and is looking extremely good. So let's have a look at the specifics. The S&P was higher by 70 points on the week. That is huge, up 2.6% on the week. And I know that members of my subscription services have done extremely well. And I've had the best week of my life personally in my own portfolios. It really was an amazing start. The index blasted through 2,700 points, and the shift in general sentiment from from doubtful to acceptance has been quite dramatic, and so we may see an acceleration in that sentiment trend, and that's got to be positive for the stock market because there's still a lot of money that can come into the market. Opportunities abound. I've got watch lists which have literally got hundreds and hundreds of potential stocks in the US. But as we go into 2018, as I indicated at the start, we're more likely to see advances getting ahead of themselves and therefore some sharp short-term pullbacks. So patience and discipline is required to negotiate successfully through 2018. But there is certainly no shortage of opportunities, that's for sure. The US dollar was lower on the week. So let's take a look at some stocks. We'll start with the S&P, and you can see if we look first of all at the red 200-day moving average line, you can see that rate of advance has been strong and stable throughout 2017. The 50-day is moving away from the 200-day, which is indicating an acceleration of the trend, which is pretty obvious because the price is moving away from the 50. But you can see that we're now at a point of deviation that we didn't see throughout 2017. Now, that's not to say that it's going to immediately come back. We are overbought, and we are further away from the 50-day than we've been in a long time. So this is not the time to be loading up in general on just anything. However, it is a time because within that significant uptrend, there are always stocks that are pulling back short term. And so that's where your focus needs to be, to find the stocks that are pulling back in the short term, that are in strong uptrends themselves or are breaking out. And if we do get a short-term pullback in the main indices, then they're less likely to be affected because they've already gone through their pullback phase. So the S&P looking extremely strong, and I noticed that this morning the US futures are trading even higher again at 27.47. So continuing to move higher. So it looks like it's going to be another good session to start this week. If we look at the NASDAQ, it's not missing out either. The NASDAQ was underperforming there a couple of times from the middle of last year as money rotated out of technology stocks and out of some of the biotech stocks and went into finance and home building and those sort of industrial stocks. But we're now seeing a resurgence in technology that is very, very positive. I expect semiconductors in America to do well again this year. And the small caps aren't missing out either. This is the Russell 2000. It's not as strong as the other indices, but nevertheless, it is basically at all-time highs. We had a breakout. We had a pull back in middle of November to test that breakout, and now we've moved away quite nicely, and the Russell is up by around about 7 or 8% since the middle of November. So looking quite strong indeed. If we look at the US dollar, we had a nice rebound. We're now going down to retest again. It's hard to reconcile this recently lower US dollar with the positivity around the tax reform and the Fed raising interest rates, so I won't even try and explain why the US dollar is a bit weaker. But all I can say is I believe the interest rate differentials will be positive for the US dollar and therefore negative for the Australian dollar, which of course is what we want to see. We want to see the Australian dollar lower if you've got your funds overseas. While I'm here, let's just look at the ASX 200. Really strong finish on Friday, and you can see that we're now comfortably above the 6,000 point mark, trading up above, in fact, 6,100. But this is a fairly meaningless indicator to me because the major stocks are not really contributing anything much to the mix other than we're seeing some strength in BHP and Rio. But the action, the profits in Australia are in the small to mid cap area. So Aussie stocks, our dollar went sharply higher to 78.7 with the lower US dollar. But look, the economist in Australia that I have followed for a long time, Bill Evans of Westpac, is normally the odd man out. He doesn't go with the consensus view, and he's normally right. He's got a terrific track record over the years, and he's still firmly on the record that he believes the Australian dollar will be close to 70 cents by the end of this year and below 70 cents in 2019. So I'm hanging my hat on his forecast, and that forecast certainly is consistent with the way we're seeing the interest rate differentials, with the RBA highly unlikely to be able to raise interest rates for several years, and the US Fed almost certainly raising interest rates. We're going to see the US cash rate go above the Australian cash rate, and there's no way that we can sustain the Australian dollar at 78 if that happens. So the strengths in 2017 has certainly defied to fundamental logic, but I think interest rate differentials will eventually force the Australian dollar lower. The only possible offset here is that we are seeing renewed commodity strength, and if that occurs, then the Australian dollar tends to be a commodity currency. So we've got a number of competing factors here, but I think the overwhelming odds support a lower Australian dollar. Our index gained 57 points last week, as I just showed. The major industrial stocks and banks are languishing, but technology-driven stocks are doing fantastically well, particularly the ones related to the finance sector. And of course, there's a lot of speculative resource activity in lithium and graphite that is really leading the way, and we're starting to see a few energy stocks pick up as well. So plenty of small and mid-cap opportunities in Australia, and I haven't been able to say that for some time. Now, precious metals, gold was higher by $46 since the last video that I did before Christmas, and trading up at 13.22. So again, the contrarian trade strikes just when it looked like gold just couldn't get any love at all in the market. The gold price has jumped quite sharply. Precious metal stocks, GDX has edged a little higher since Christmas, but nowhere near to the extent that you would expect from gold. So therefore, I'm not really expecting this trend to really gain sustained momentum. And this sector remains very much a stock-specific sector to trade. If you've been watching these videos for some time, or you're a member of one of my subscription services, then you know that my favorite Australian stock and probably global gold stock is Northern Star Resources. I just don't think there's a better financial performer out there. And stocks like that have done really well, new all-time highs, but that's not the case for across the board. So let's take a look at precious metals. So there's the move up. This was the low here on the 11th of December, the last video I did just before Christmas. We were probably trading around the 1268 mark. You can see it's been an almost vertical rise since then. So a lot of strength in gold. If we look at this on a weekly, we're still constrained by this bigger picture overhead resistance at 1380. So gold needs to get above 1400 to usher in a new bull market in gold stocks. Speaking of gold stocks, this is GDX on a weekly basis. You can see there's been a bit of a move, but there's really nothing there yet. And because we know that gold stocks lead, I just don't see the gold sector being sustainable at the moment. So cherry picking a few of the best stocks is I think the only way to go in the gold stock sector at the moment. Turning to other commodities, copper worked its way higher to 320. That was largely currency, but we're certainly seeing an increase in demand. And 2018, I've been saying now for 2 years, was going to be a point where there was a greater shortfall, 2018, supply versus demand. So we should see copper continue to move higher. Crude oil was also sharply higher since the last video that I did, up to 61.5. And we're now finally seeing the big breakout finally being confirmed on a broad basis within the energy sector in America. It's looking very, very good. There've been some canary trades over the last couple of months. What I mean by canary trades is a few of the leading stocks, particularly in the energy producer and explorer area. There's been some stocks that have done quite well, but we didn't have a general breakout. Now we've got a general breakout. So quite clearly, the energy sector in America is the most powerful sector in the US at this point in time. Let's just take a look at XLE, which is the energy index. So you can see we'd formed a nice base through here. Managed to break out of that base, formed another reaccumulation zone up at a slightly higher level, and now we've moved out of that very powerfully. So the energy sector well and truly underway, and the forward estimates for earnings for 2018 for the energy sector are extremely strong. There's the spot. There's the spot copper chart, 6 month. So there's a big picture general trend to the upside. You can see in July we were trading at $2.65. Now we're trading at $3.20. So there's a general uptrend with a bit of a case of 2 steps forward, 1 step back, but that's all relatively orderly. And there's the crude oil chart over the last 3 months. So to wrap it up, I expect an acceleration of the gains in 2018. The message from the market is crystal clear from all the charts you've just seen. So this is not a bit of a wild guesstimate on my part. We're seeing an acceleration now, and all the fundamentals are in place that would support that acceleration. And we're also starting to see a change in sentiment, which of course is what's required to really drive that acceleration. So I think that message is pretty clear. History shows that once sentiment moves past the acceptance stage, that we then have another 12 to 18 months of large gains. So the market sentiment started to shift really positively in 1998, leading into 1999, and there was another year to 18 months of strong gains before we reached the peak. Similar things happened in 2005, 2006. So there is no need to be concerned that this sudden acceleration in the market is going to lead to a sudden market top. That's just not the case. However, as I indicated on the S&P, as prices start to deviate more than normal from the long-term trend or from the 50-day moving average, then inevitably we'll get some pullbacks that are a bit sharper and a little bit deeper than what we've seen through the last couple of years. So there'll be some added volatility, but that's great because that allows us to get into stocks at a lower price, and also to then see a subsequent acceleration of that trend upwards. So don't be frightened by higher volatility. As long as you can work with it, then it actually provides a better environment for trading. But process and discipline is more important than ever, absolutely critical, and that's what I hammer with all of my subscription services about the way that we get into trades and the way that we manage trades and take profit. Portfolio analyst this week, I'm going to do a review of some local resource opportunities. There's been quite a few presented in portfolio analyst from members' questions, but I'm going to have a bit of a look at that. And also present an interesting blockchain opportunity in the US as well, plus another local gem that I think it will turn out to be. So that's the rundown for this week for the first edition of 2018. There's my contact details. It's been a wonderful start to the year. I really think 2018, if you've got your act together, is going to be very, very profitable. And we need to cash in while we can, because these conditions are not going to last forever. 2018 looks good, 2019 maybe, but after that, if we get this acceleration phase, then there may not be too many more years before we get something a bit more meaningful, something that looks more like a 20 to 25% correction. So that's it for this week. Cheers.